Hi, and welcome to another market update. I'm joined today by KC Lowe, Senior Consultant in our Capital Market and Asset Allocation team. KC, how you going?
Hi, Phil. Good, thanks. We're in the new office.
Fantastic, looks good. I guess 2020 was a pretty amazing year for everyone in the whole world, but also in financial markets. When you look back over the last calendar year, can you give us an update of exactly how markets have unfolded?
Yeah, so I'll start with equity markets. So if you look at Australian equities, we ended the calendar year slightly positive, around about 1% higher. But then if you look overseas, developed market and emerging market equities ended the year above 10% in local currency terms. And particularly if you look at the US market, US equities returned about 15% over the calendar year, and then US tech in particular returned over 40%. So when you look at equity markets alone, you'd think, what pandemic, what global recession we're in. It doesn't seem like that's really affected the market at all. And the reasoning behind that is, the large amount of government support and central bank support. So if you look at the cash rate, we started the calendar year already at record low of 0.75%, but that was by the end of 2020, that was reduced to 0.1%. And the Reserve Bank of Australia also started targeting bond yields and started their own quantitative easing program as well. So quite a lot of support there. And if we turn over to foreign currencies, you look at the Australian dollar against the US dollar, we started the year at about 70 cents. And in March, we got as low as 55 cents. And then we ended the year at around 77 cents. So it's been quite a wild ride for foreign currencies as well. And for commodities, iron ore, which is very important for Australia, it increased by over 70% over the last year. And that's driven by both supply and demand issues. So on demand side, you have China stimulus, particularly on infrastructure. And on the supply side, you have supply issues in Brazil supporting that. So quite a lot's happened there.
Fantastic. And I guess you touched on the start, obviously global equities seem to have done particularly well compared to Australian equities. When you look, taking a step back, like what are the big global events that have really been shaping, all of those moves?
So most recently, maybe I'll touch on the US and China in terms of the key points there. So on US, with the recent runoff elections, it does seem like the Democrats have control of the House of Representatives, the Senate, and the White House now. And what does that mean? Well, it means that Joe Biden's agenda is likely to get through a lot easier than previously expected, so potentially more stimulus. So on the stimulus side of things, the president did announce that he's planning to have a $1.9 trillion rescue package to support the economy through COVID-19. And that's roughly about 10% of the US GDP. So in total now, the amount of fiscal support that the US has pumped into the economy as due to the pandemic is getting close to 25% of their GDP. Now, to give you a comparison, that's about 3 times the size of support that the economy received back during the global financial crisis. So it's a huge support. That's if that 1.9 trillion package gets through and it's not watered down too much. So quite a lot there in the US. And then the other one on China is that they've recently released their fourth quarter GDP number, and they've ended the year positively. So they're probably the only major economy to have actually grown over 2020. So quite a significant feat there.
Fantastic. And then just briefly looking at more like closer to home, like how are things going domestically and what are the things that you're looking at there?
So the Reserve Bank of Australia, they don't meet in January. But what's interesting to note is the housing market here. So despite a pandemic, and our border closure having uncertainty for demand, it seems that record low or near zero interest rates here, on top of the huge government support that's been provided, that has really helped our housing market here. So if you look at both credit growth numbers, particularly mortgage loan growth numbers, and also dwelling construction approval rates, those have all been increasing since around middle of last year. So if you look at owner-occupier loan growth, that's grown by over 30% annually, based on the latest data to November. So it's quite strong numbers right now.
Well, it's good news for homeowners, I guess. But thanks very much for the update, and thanks very much for joining us for this month's market update.